Are you?
Heck yeah, dude. I'm going to bump up our numbers.
uh, welcome to the.
Oh, wait, sorry.
Oh, what? I think we're live, man.
No, I didn't hit live. What?
It says live.
Oh.
Yeah,
Okay.
we're live.
Okay. We're not live on Facebook, is what it is.
Oh, it's all right. Welcome to the Infinite Wealth Live
As you can tell,
version.
we're live.
Infinite Wealth Live version. Every third Thursday, come here, join us for all your questions in regards to infinite banking and just general finance questions. We guys do this as a service for you guys, so you can reach out, get a little access to us, and a little bit of FaceTime, right? Anthony, what do we got going today?
So we're if you got questions, go ahead and throw them in the chat. We have a couple already, and if you have one and you're not, maybe you're watching a recording, send us a DM or an email, or just send it to us, and we would gladly put it on our next live event. And so I know we got two. You got one when somebody asked you, should you pay cash, or why pay cash versus a policy loan?
Yeah.
Right? And then I had a question from the CPA. So, it's probably an intelligent, detailed question.
And where do you get those sleeve protectors?
Yeah.
Pocket protectors?
No, pocket protectors.
Yeah.
Sleeves we roll up, right? So we don't get, we're not hiding money in the sleeves. What his question was relating to a video that we had done before, comparing buying term and investing the difference compared to buying whole life and investing the cash value. And in the scenarios we ran, we were using a 10% rate of return each and every single year. We got that number because we did this for a client, and that's what he said he could do. And Chris's question was, well, what happens if we have a lower rate of return? And so what we're going to do is we're going to reopen that spreadsheet, right? Let's look at some numbers, and we're going to kind of see.
Somebody's excited. Somebody's excited. Yeah. Awesome. All right. The question I had this week was one we get often, right? Is a gentleman who's actually been a client for maybe 6 months or so. He's put a couple things in place. We're started underwriting again on him, and we're talking to him. And he goes, Cam, he's like, you know what? He's like, I was talking to my wife about this, and I told her what we're doing. And she was asking, well, why wouldn't you just take the cash and go buy the rental property? Anthony, you know what I said to him?
What'd you say to him?
I said, that's why your wife needs to be in on these meetings.
Well, I would tell you, when we talked, but you told me something earlier.
What?
You called it like she needs to be in the meats.
That's not what I said. That's what you heard. That's what you heard.
You didn't say something's short?
No, I didn't. That's what you heard.
Man, you said something kind of trying to be cool, but she's got to be in the meats.
I'm not cool, but
right.
Yeah. All right. So that's what I said to him. And so I'm going to give you guys a big overview, and we're going to give you some additional resources where you guys can go and look that information up and watch it in detail so that you guys do understand exactly what the benefits of that are. You want to get started?
Are you not going to give him the answer, or are you going to?
Yeah, I didn't know who was going first. Okay. I'm happy to go first. Yeah, as if we're looking at cash versus IBC, this is one of the questions we get often. And really, again, it comes up in times like this where somebody doesn't quite have a good understanding exactly of how a policy works. And really, I think it comes up in regards to why would we pay interest, right? And so the question that the wife was asking is, why we have a sum of money, why don't we just go buy the rental instead of running it through this insurance policy? Guys, at the most basic level, right, that policy is an asset. And so if we just look at a cash option, if you've got cash sitting in a checking account, savings account, and you take that money out, it stops earning for you. You turn around and you make that investment. You've got now one investment, which is the real estate, which is good. But now you've got one asset that's earning for you. The cash is now in that equity in the house. And now that is earned for you. So you only got one asset. If you guys rewind and we go look at the infinite banking option, right, is we're going to run that money through a policy. So we pay premiums, we create cash value. And then what we're going to do is we're going to borrow against the cash value, and we're going to go invest and acquire the real estate just like we did in the first option. But what you need to understand is you've got that cash value that's in your policy continuing to grow and compound, not just this year, but every single year moving forward. And so the longer you have that policy in place, the greater your gains are. And so one of the things that we'll do when we give this example is we'll go through just a borrowing strategy example, and we'll show you what it looks like if you go buy that real estate using cash. And then what we'll do is we'll load up the life insurance illustrations, and we'll account for the interest that we got to pay. And it always comes out ahead. And so that is an example that we've done many times. If you guys have questions on that and you want one of us to go through it with you just individually, man, we're happy to do that, right? We'll take the time, takes maybe 15, 20 minutes to go through that example. Shoot us an email. We'll gladly jump on a call with you and go through that. And then also we've done videos as well. So we'll also share that link in the notes to this episode or to this recording. And it's called Cash versus IBC. Anthony does a deep dive. He goes in there and he just lays out the numbers for you. So we've covered this extensively, but it's always good for a little bit of review.
I tell you that's one of my favorite videos.
It's because you're in it. You do
Not because I did. Well, actually, all my 3 favorite videos are ones that I've done.
No, surprise.
I'm trying to think any videos my favorite that you were in. None. But
I've got one video.
With this video, Cash versus IBC, this is what hit it home for me. Because we're constantly talking about a theory, which theory's great, but I'm more of the skeptic. I'm the analytical. I need to see mathematically and logically while doing whatever concept we're talking about. How is that going to help improve my results? And that's exactly what we do in that video. We compare a few different scenarios, and you can really see mathematically the power of compounding. And there's a lot of things we don't talk about in that video, meaning there's some ways that we can create tax deductions, meaning the interest, the tenant's paying on that loan repayment, right? Because remember, if we're using this by an asset, ideally, you're not paying that interest or that loan back, your tenant is. And when you use a policy loan to create taxable income, we can deduct that interest we pay to the insurance company against that income. So there's tax deductions, there's the asset protection, and then there's also a death benefit, right? But that video is really just talking about what most people want. I want more cash. And which way is that going to get me there?
Also, another resource, if you guys are like me and don't want to listen to Anthony talk for 20 minutes, then I would recommend go get Nelson's book on page 44, page 45. He goes through exactly that example, right? He compares using a CD versus his insurance policy, and the numbers, the book's a little dated. It came out in 2000, but man, the concepts are still spot on. And so take your time, go through, read that book, and then come to us if you guys have any questions. Happy to help.
Right now, here's a comment here. It says, people seem to understand the concept of leaving the cash alone, so it keeps working for you. Right. And then he also mentioned, on a policy, then we get the renters to pay it back, and that is a little hard concept to think about of having a loan, right? And we really need to understand. And one thing that I like to point out, is a loan an asset or liability? You want to play along, Cameron? I know you know the answer.
It depends on who I am,
right?
Am I giving
who are you?
Loan?
That's a really good question.
Am I giving you the loan?
But no, like a client. But how do most people answer it?
Most people think it's a liability.
It's a liability, right? But as you alluded to the answer, it depends which side of the table you're sitting on. If you're receiving the loan, it's a liability because you owe that money back. But move across the table to the banker. What is it on the banker's balance sheet? Is it an asset or liability? It's an asset to them because they're receiving money. So when we are practicing infinite banking and we're becoming our own banker, we're in the banking business. So we need to realize that those loans is a liability and it is a asset.
Can you pull up that comment a minute ago? I think that was Garrett. Garrett, if that's you, man, what's up? The first part of it says people seem to understand. People seem to understand the concept of leaving the cash alone so it keeps working for you. Man, I totally agree with you at that sentiment. And I think that's part of the education process that people need to go through is it was instilled in me that the best thing that I could do with money was take it and just set it aside over here and just leave it. Right. And that's what was told to me, right, from a little kid is, hey, you always got to save. You got to put it away and save it for this long, far off future date or this event. Right. When I read Nelson's book, Nelson talks about the velocity of money and turning dollars. And this is how business owners approach wealth creation, right? Is they find something that they can just turn as many times in a year as possible. And so once we realize that, hey, I can make more money by taking the cash that I have, the capital that I have, and then turning it or cycling through it as many times in 1 year as I possibly can, you're going to end up with more money. But that is an education process, Garrett. I'm glad you pointed that out, is because that's like the least efficient thing that we can do is just taking cash and putting it aside and letting it sit there.
Now, I got another question that was asked to me last night.
Great.
But
Go for it.
I'm not. I think it kind of goes. Well, no, I'm going to answer it next. Okay. But the question that we had that was sent to me was, does again, it was relating to a video and podcast we did, and what we did is we had a client who had a policy. He's like, Anthony, why should I fund my policy? Because I'm earning 10% every year in the stock market. Now, I will say that this guy was a real investor. He wasn't just throwing things into an index fund. He was researching companies, and actually buying the actual stocks. And then I said, remember, the policy isn't an either or. We're not saying put the money in life insurance or the stock market or whatever your investment of choice is. This is an and asset. We can leverage against it and buy your investment by choice. So what we did is, which oftentimes you hear us say, is we did the math. And what we did is we had compared him putting, in this case, he was putting 20,000 away into a policy. Well, what if we put that same 20 in an investment account? Okay. And what he was thinking, he was just really looking at the cash value of the policy versus what he could earn in the investment account. And, I guarantee he wasn't taking into account term insurance, because if he was going to cancel his policy, he need term insurance, and he wasn't including taxes. So that's what we did in this spreadsheet here. And I'm going to go ahead and pull it up. But yeah, I haven't shared screen on this in a while.
Don't screw it up.
Oh. Boom. Okay. Okay. Yeah, sorry. This is the fun about doing live. Let's just do the entire screen.
I'm going to pull this one down.
6. Okay, so I'm going to run through this fairly quickly, because and we're also put in the notes of where you could find the video where we go into a lot of detail. But so I'm just going to kind of, what we have here is we have earning 10%, and let's just look at the bottom line. So right now, we had compared buying a term and investing the difference versus taking a policy loan and buying the same investments. And as you're going to see, buying whole life or using IBC, we had 53% more for doing the exact same thing. Same money going in, but we had almost half more going out. Now, so what Chris's question was, cool, this is great at 10%, but what if, right now we're not really earning, right? We're not really earning 10%. So what I'm going to do is I'm going to change this to 5, and let's see what it looks like. 74%. Okay. Well, I would tell you, when I ran this, I wasn't sure where it was going to go. All right. But that's why we need to do the math. Now, where people were maybe right now or last year, so we have zero income or zero gain on those investments, 100% more. And I would tell you, at first glance, I was surprised. And I know if I was surprised, then Cameron was definitely surprised. Okay. Now, but then we started realizing as Cameron had talked about, the power of compounding, right? Our policy is continuing to compound even though we're using it. So as you can see here, the most we can buy with buying term investment difference, 20 grand a year. That's the maximum amount that we have to invest each year. But you're going to see here with IBC, we start off a little bit slower, right? But here we can invest in $21,000, right? And here we can invest in 30. So IBC is buying 30,000 of assets, while the Dave Ramsey is buying 20, right? And then here we're buying 40. So this is an example of the power of compounding. So that's why even with the low return or even no return, we still have more. So let's see if we have a loss. So, moral of the story here. Moral of the story here is that power of compounding and using infinite banking is going to increase your returns, whether you make a lot of money or you don't. So
well said. Well said. Sorry, I was reading the notes. Garrett, I think threw something in there.
Okay. All right. He likes spreadsheets. Okay. Well, maybe.
Oh, he said yes.
Well, I'm just going to put, all right. Somebody likes spreadsheets.
Yeah. Garrett will send that to you, man. You can
but then he
knock
says,
yourself out.
Well, maybe. So a question I got yesterday, and we couldn't see the spreadsheet.
Just broke Anthony's heart. He's devastated.
Yeah, because that was pretty powerful. Well, we're going to have to figure that out. I'm going to have to re-record that because that was pretty powerful. You should have seen Cameron's eyes. He was just blown away. Just blown away. Mm-hmm. Okay, so this was a client who she's sitting on large amounts of cash right now. And she's concerned, hey, I need to put it to work. And well, let's just be clear. This person is my daughter.
Okay.
Right. And as I've shared before on here, that she's had some medical issues. So I'm not sure if we can get a policy on her. So we're in the process of trying to do that. It's taken a long time. And she's like, well, Dad, I'm feeling stressed that I'm sitting on this cash and I'm not doing anything with it. And so, what I'd say, maybe you can feel the same, where sitting on cash and maybe you don't want to buy a house, or you're worried about the stock market. I would say right now, sitting on cash, I think, is a great idea. We need to be in liquidity, because we're starting to hear more and more about this recession that is coming down the pike. In fact, I saw a video today where I think it was Citibank or Capital One was no longer going to loan money to car dealerships. Mm-hmm. All right, because they're worried about the risk. And but then that can kind of trickle down, right? Because then these car dealerships can't sell the cars. And so, but they have a lot of inventory. So there may be a big adjustment in car prices. And it's kind of getting similar to commercial lending. A lot of the commercial lending is done by local or regional banks. And there's, with Silicon Valley Bank closing, and there's been some more risk and some concern about the impact if there's a crash or an adjustment on commercial properties and the impact that's going to have on these local banks. But I would tell you, when I hear all of that, what I hear is opportunities.
Mm-hmm.
Right? What I hear, not that I'm looking for a car, but I'm thinking there may be some deals on cars. There may be some deals on some commercial properties. There could be some deal on some single family homes. But what's going to happen is these banks are going to tighten up. And so it may get harder to get access from banks. So we need to, that's where it's even more important to become your own banker, where you have that cash so you can take advantage of those opportunities. And even though you might have in some FOMO that we're not building or putting that money to work right now, the key thing is you're not losing it. Because where are you going to put it somewhere short term? Because I know my daughter wants to buy a rental property and a home probably within the next year, but you put that in the market or some asset where it can lose money, it may jeopardize buying those assets. So we just need to bite the bullet and it's be okay on cash. And then you know what hit me? Right. I'm like,
maybe Vicky,
well, that's a whole nother story. But so she's sitting on some cash and doesn't know where to put it. And then I'm thinking, you know what? I have some policy loans that I'm paying, 6 to 7% on some of those loans. I'm like, hey, why don't you just transfer that money into one of my policies? And then instead of me paying 6% to a bank or insurance company, I pay the 6% to you. So that to me, I felt was a win-win.
Yeah. And for those of you that are listening over the age of 21, FOMO means fear of missing out, just to keep you guys up to date. Yeah. Awesome. Great point. Good insight, Anthony.
Well, and to me, the moral of that story is we need to view our policy as a place to store cash. If there's cash available, I know a lot of times when we're teaching it, we're like doing one asset, right? Buying that asset and that asset repays it back, which is totally fine. But if we're sitting on cash somewhere else at somebody else's bank, let's move that into our own banking system.
Yeah. I think Sarah needs to buy a policy on old dad over here.
Well, she's smart enough to say that. She's like, well, can I get a policy on you? And I'm like, yeah, dad doesn't want to get examined and go through all that stuff again, but I will for you.
Okay.
But ideally I want to get her a policy, but if we can't, she will get one on me.
Yeah. Awesome. Good stuff. Good insight on kind of the family dynamics. Look like you got something else.
No, I want to make sure we talk about some live streams we have coming up.
Yeah, we got some good ones, right? We've got Rabbi Daniel Lappin. He's going to be joining us Monday, May 1st. We'll be going live here again. If you guys have read any of his books, feel free to come and join us. Opportunity to post any questions there. We've got Mark Podolsky, the Land Geek, joining us Friday, May 5th. Again, if you guys have questions on maybe getting into land, or maybe you're in it and have some stumbling blocks or obstacles you're up against, feel free to tune in and ask him some questions. And then also Friday, May 12th, we got Todd Langford. Todd Langford is the genius behind the calculators that we use every day, Truth Concepts. This guy knows a lot about a lot of stuff. And so make sure you guys come join us. We'll be diving deep on some of these questions with Todd. So look forward to having all three of these guys.
Go make it a fantastic day.
Take care.